Hub. With that, let's bring in our guest, Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Tom, welcome back to the show.
Thanks for having me, Anne.
Let's talk about futures right now, Tom. They're in the red as investors await new job data for the month of March. Walk us through why investor sentiment is negative as the report approaches, when we've actually seen a fairly robust bump up in stocks over the last 2 weeks or so as the SVB situation seems to have been resolved.
Yeah, it's a great question, Anne. I think we're in an information vacuum, waiting for these data points, waiting for the jobs report tomorrow, but most importantly, waiting for earnings. And earnings are expected to be weak, down 6.3% year on year. But the thing that's been surprising to me, Anne, is the fact that we haven't seen a lot of pre-announcements. You would think with earnings going to be so bad, you would see companies getting out ahead of it, which makes me believe that maybe the bar is so low they can step over it. As far as the data that you referenced, the ISM manufacturing earlier in the week was weak. The initial jobless claims coming in at 237,000, the continuing claims at 1.8. I think all of this is giving the Fed a little bit of cover to maybe their dot plot is at 5.1%. Maybe pause, maybe go one more, but not a whole lot more than that. And I think the market is sniffing that out. You're seeing it in the 10-year yield. So we've got a lot of important information coming up in the next 2 weeks. And after a big run that you referenced, moving into the end of the quarter, I think we're doing a little bit of digestion here, Anne.
Let's unpack earnings a bit more, Tom. You just said that you were surprised that we haven't seen pre-warnings yet. That being said, we're only 6 days right after the end of Q1, so it would be a little early for companies even to get their internal flash results. So if we take a step back and look at it from a macro perspective, which sectors are you expecting to see perform how? If we can break it down, industrials, financials, tech, for example.
Yeah, I think what you're seeing here is the big tech free cash flow generators, and you referenced a couple of names. We own some Alphabet. It's good to see what's happening with also their chip announcement yesterday that their AI chip, the Tensor chip, is 1.7 times faster than the NVIDIA chip. So I think people have underestimated because they had such a faulty launch of Bard. It was kind of a debacle of sorts, but I think they're underestimating the amount of AI that they have to compete with ChatGPT and the hardware. You need the cloud. Obviously, they've got unlimited cloud, as does Microsoft. But now with the chips to be 1.7 times faster than NVIDIA, that's a major thing. So I think we're going to be.
Point, Tom. Can you just to pause on that for a second? Because that is such a big story. And in terms of where Google is manufacturing those chips, so much conversation's been had about chip manufacturing overseas versus here in the US. Where is Google looking to make its super chip?
Well, I think that's good. It's developed internally. Where they source it to, I think will be spread out, and we'll know more over time as they continue to produce it at scale. But the key is the technology. It's no different than NVIDIA. They come up with the technology, they come up with the innovation, and then whoever produces it, whichever fab. But we're seeing more and more of the fabs start to come into the United States, as we know about Phoenix, as we know about Ohio, as we know about the CHIPS Act. So I think where it's ultimately produced in scale is going to be less important than the technology that comes out of both NVIDIA and out of Google that's going to drive growth and innovation moving forward. But getting back to the market a little bit about your point about bearishness, it was a good point that you made. The one thing that I've known, and I've been in markets for almost 2 decades, is that markets don't tend to top when people are overweight cash and bonds. And we're seeing that right now. You saw the Bank of America Fund Manager survey just about a week and a half ago. Investors more bearish than the great financial crisis lows, the European debt crisis lows, the pandemic lows. So with expectations so low going into earnings season, I think it's very positive. And usually this is the time, the first 2 weeks before banks start to report as early as late next week, is when you would see some of these companies start to pre-announce. So maybe they'll come out after the holiday, to your point. But I think it's a positive sign that we haven't seen at least a few come out this week, and we'll see. With expectations so low, that's a positive thing. But it's all ultimately going to come down to the Fed here. If we continue to get weak data, that's going to be constructive, before May 3rd, and tomorrow is a very important data point on that front.
We've also got March retail sales data releases coming out, Tom, next week. weight that you would put on that report? What are you actually expecting to see from it?
You know, mixed signals and crosswinds, right? I mean, Walmart 5% up, constant currency, good. Costco today a little bit mixed, a little bit soft. So I think on balance, people are still spending, but they're being more selective. You're seeing still strong spending in travel. So we're gonna have to see. You know, it's been strong. I think the Fed wants to see that a little bit weaker, to be candid, and maybe they'll get that next week, and that'll be another catalyst to say maybe the Fed has accomplished their mission, and they can start to ease off a little bit, and that would be constructive for markets. You know, I think that the big thing here is this. The sooner that they pause, the longer they can hold rates elevated, and that's important for them to ensure that they accomplish their mission. If they continue to hike too aggressively, they're going to have to cut, and that's not a good thing for markets. You know, what we've seen historically, if they just stop raising and don't have to pivot, which is a different story. But if they just stop raising, 6 months out, the market's up on average 13.2%. 12 months out, it's up on average 18.9%. And 24 months out, after they stop hiking, it's up 34.7%. So there could be some good things in the cards moving forward. We know that Q1 and Q2 economic results, earnings results are going to be really soft. That's why the market corrected 27% peak to trough last year, discounting those problems. But I do think as we get to the end of Q2 here, that the market's going to start to look to 2024, and maybe earnings aren't 248 that they're currently estimated at right now, but 240, 235. That's very promising, and the market will start to look forward to that. And I think that's why you did see some strength into the end of the quarter, a little bit of digestion now that we're waiting for new data, but overall constructive.
Let's just push a little bit, Tom, on this idea of the Fed starting to pause. I feel like the market just has not been listening, right? And we just saw yesterday Federal Reserve Bank of Cleveland President Loretta Mester explicitly said Fed officials will need to raise interest rates a bit higher and hold them there, quote, for some time. Yeah. She doesn't see inflation returning to the Fed's target until 2025. So, and she's now the third senior Fed chief over the last week or so that said this. So where on earth is the market getting this optimism that the Fed's going to stop? They're being pretty clear they're not going to.
Yeah, no, you make an important point, but I would say two things. Number one is Bullard and Mester, who have been the front-runner hawks in the FOMC. They're both non-voting members this year. So they play an important role to pin long-term inflation expectations, and they've been very, very successful in bringing down one-year inflation expectations and five-year inflation break-evens to levels in line with what the Fed is looking for in terms of their target. So what they say is valuable in terms of anchoring inflation expectations, but less valuable in terms of policy moving forward. The most important is what Powell is going to be doing moving forward. And he did reference disinflation, but he does really need the data cover. And now he's starting to get the data cover. So we'll see. Look, at the end of the day, what Mester said and what the market is saying is not that far apart. You're talking 25 basis points. And even what their dot plot is saying, you're talking 25 basis points. So I don't think that's a big deal one way or another. I think the market can probably digest that. And if they hold it there, then they can keep rates elevated, which would be very, very constructive. If they go too far and have to pivot, that's going to be a problem.
Thomas Hayes, Chairman and Managing Member of Great Hill Capital, thank you as always for joining us this morning.
Thanks.